Now let's take our conversation forward with him. Aman, good morning. Thank you for joining us. The big event risk on what Fed would do and how they, in a sense, would indicate their outlook for the US financial sector, that is behind us. If this was the biggest risk for the market in the near and the short term, why are markets not celebrating it today? Because at least in my book, we've come on the right side of the event.
I think the market was expecting a much more dovish commentary from Fed, which has not come in. So Fed has mentioned that they would not shy away from taking more rate hikes if it is needed, though we feel it won't be needed, but that's what the commentary which came in. So market was expecting much more dovish commentary that we are there, we are the big daddy, anything else fails, anything else goes down, don't worry, we'll take care. So those commentary was missing, and that's the reason I think markets are not as excited as what we would have believed it to be.
Okay. Given that a lot has changed this year, both for global markets and for Indian markets, interest rate hike fear is not behind us. The issue in the US banking stroke financial sector is now real. World economy is slowing down. How have you changed your portfolio positioning?
Frankly, then that's the dilemma that we are also facing. The world economy is slowing down, but Indian economy is doing well. Indian markets relatively are doing well, but we are also depending on foreign flows. So that's the dilemma that we are facing as to which way to focus on. So the way we have shaped our portfolios, and the change in stance has been one clearly in the last 1 month since we last spoke. IT, I believe the recovery that we expected in IT will be a bit delayed because of the banking crisis that's going on, because that's the biggest segment the IT sector is facing. And besides that, we are getting more constructive on the pharma space. This is something where we feel over the next 1 to 2 quarters, margins as well as growth rates can bottom out and things can start to look up. Sector has not performed for more than almost a year and a half now, and it's a decent priced sector for the kind of global corporates that Indian has. So that's been the change in stance over the last month or so. Overall, clearly avoiding stocks or sectors which have global exposure, which have export exposure, unless you are gaining significant market share in the global markets, and focusing more on domestic demand, domestic economy-led companies. So that's been the stance so far.
That's quite interesting, Aman, the views that you just talked about when it comes to pharma. Tell us a little bit about, where you find preference in pharma, considering the varied sector that it is.
So in pharma, clearly what happened is during the COVID crisis, one, there was pricing power for many of the companies, which they have given away over the last 12 months. So from a high COVID base, now we are seeing profit declining, which should bottom out in the next 1 to 2 quarters to a new normal base, from which on the steady growth will continue. So that is one segment within the pharma space that is looking interesting. Second is the companies that were importing raw materials or APIs from China, which stopped due to COVID, and hence they had to pay a much higher price, impacting their margins. Now that is also reversing. So we have already seen resumption of low cost APIs and other intermediaries from China and from other markets, and now the margin that they lost, they are regaining gap, and hence due to this lower raw material input, the earnings growth will come back. So these are the two segments that we are very clearly focusing on. The other segment is the domestic pharma, which I believe was always steady, and it's not something that is within the valuation band that we look at, which is like a decent valuation range. So they all trade north of 30. So that segment is also interesting, but not something that we are focusing right now.
So, Aman, where do you think this market now is giving you comfort of value and growth?
Overall, financials still continue to be attractive. Obviously, last few weeks they have been at the receiving end because of the liquidity and the news flow factors, which make them even more attractive, because Indian banking system is completely domestic. So we are not dependent on global events for the growth, and no economy can grow without the banking sector participating. So that segment is still looking good to us. Pharma, as I mentioned, is now looking good. sectors like cement or which consume commodities. So the coal prices are down, crude prices are coming off. So all those sectors which faced margin headwinds due to higher commodity prices would now again back in focus. So that's where our focus lies.
Aman, the other thing I also wanted to talk about is how you're viewing, the global stage at this juncture. Because, the last we spoke with you, you talked about as to how you don't see much of an increase in China weightage. When do you think the FII selling, though, for India is going to stall?
I think it's another 3-4 months till the dust settles in US. And frankly, see, last year, the CY22 was the first year after several years where investors, both equity and bond markets, lost money in US. And that looks like continuing in the current few months also. So till the time dust settles there and they start to resume looking at rebuilding their portfolio or reshaping their portfolio, that is the time I think the Indian market will start to see FII inflows again. Till that time, I think it's more of redemptions from their clients and from their own personal portfolio that is leading to this outflow rather than money moving out of India and going into China or going into other markets. It's more of shrinking of the portfolio rather than rebalancing the portfolio versus India, which is going on. Once this settles and they start to resume inflows, I think India stands to be a natural beneficiary because as we discussed last time, there are not many options for a global investor to invest like Sri Lanka, Pakistan are bust. Nobody wants to meaningfully increase the China weightage. Turkey, Greece, Portugal, hyperinflation. Indonesia, Brazil, commodity-driven economies not doing well. Europe, we know the Russian crisis have dragged on for almost more than a year now. UK, political turmoil continues. So, not many options. And within that, India stands out versus, say, Malaysia or Thailand or any other smaller economies or the neighboring economies that we have. Hence, I have no doubt that the FII flows will resume, but they will resume when just settled in their own market, in their own house. When your house is on fire, you first want to handle that before looking at something else. So, another few months at least is what my guess would be.
Why do you like sectors like infra, construction? I mean, these are sectors which will have issues in terms of the interest rate. They are direct play to economy. And see, these stocks in general have done rather well for themselves. So why specifically do you like infra, construction?
See, for the next 12 months ahead of the central elections, I see the award activity and the tendering activity to go on a high, right? So that will give them good visibility. And with cement prices and coal prices coming off, the risk to margins is also not there. So because of the combination of this and plus decent valuations, these companies trade at anywhere between 10 to 15 times the FY24-25 earnings. So it's a decent risk-reward equation that we have in this sector. So the issue in this sector always has been working capital, and we have seen cycles where companies have gone bust and new set of companies have emerged after every cycle. And every new company coming in now is aware of this, that the biggest risk is working capital, and hence they are quite mindful of where they're getting into. Last cycle we saw many companies getting into BOT, getting into owning their assets. Now we have a clear list of companies which have said that no, we don't want to own assets, we are just contractors, we'll just build and deliver, we don't want to own anything. So this is the space where you learn from your past mistakes, and that's the reason we feel that companies which are clearly focused just on execution stands to stand out, and obviously next 12 months are going to be interesting on the auto infra front.
Aman, morning. I just wonder what the outlook is when it comes to the auto space, because I didn't really spot that among the list. Given the fact that we are seeing an impending CV cycle recovery, a softening in raw material prices, etc., what is your outlook on where the auto sector stands?
Outlook is positive, though we don't have a big exposure in our portfolio in the auto sector because we feel it's pretty cyclical in nature. So we have one good year and coming with on the backdrop of 2 bad years. So it's not something that we are very excited from a 3 to 4 year perspective. But in the near term, clearly, as you mentioned, demand is looking up with lower oil prices and with lower commodity prices. Earnings seems to be coming back to the sector. And I think that's reflective in the portfolio performance also. The stocks have done well.
Have you participated in any of the recent IPOs? A lot of PMS fund managers of late, either they've bought Bikaji, some have bought Bikaji and Metro, some have bought Bikaji Metro and Campus, some have bought all three. Are you in that all three approach, or you've avoided this space completely?
Avoided the space completely. The companies that you mentioned, these are all good companies. We like them, but not the price at which the IPOs came in. So that's the reason we avoided them.
Among markets, they always follow a style, right? And what has done very well for the fund house which you represent is your whole onus towards buy companies which are available at P multiples which are less than 15, return ratios of 15 and growth of 15. Now that style has done very well. But do you think that style may not do very well going forward, considering that if interest rates come back, growth stocks will come back and growth stocks will not be cheap?
So the valuation metrics that you mentioned about that 15% ROEP and growth, what we focus is that any two of these three criteria should be met. See, all three criteria can't be met at any given point of time, because if that happens, then you are in a great situation that you get a great company at a great price, which practically speaking doesn't happen. So any two of the three criteria should be met. If I keep that perspective in mind, even now there is enough of opportunity. Even if the style changes, the growth comes back, interest rates can top up and starts to come off, then maybe we need to pay a slightly higher PE multiple for the growth, and we are pretty fine with that. So if the overall, beyond the valuation framework that you mentioned, we are basically value conscious investors. So we don't mind paying a premium, but the premium should be justified. Obviously, if the company is going at 10-15%, I do mind paying a 70-80 P. But if the same company is at 15, 20, 25 P, I don't mind paying that premium, because that's a justified premium for the kind of growth I'm getting into. So keeping that in mind, I think even if the style changes for the market and growth stocks come back, we think this approach of ours would help.
Thank you, Aman, for sharing with us your outlook on the markets, individual sectors, and where your preference lies.